Welcome to vTalkInsight, Allocator's Lens Daily for April 16th, 2026. Record equity indices, a powerful AI earnings story, and sharply lower volatility are colliding with a stressed physical oil market and tense ceasefire negotiations in the Gulf. Today is about that tension between a risk-on equity narrative and a still fragile macro and geopolitical backdrop. In equities, the headline picture is still exuberant. The S&P 500 is at record levels, up more than 10% from last month's lows, with several strong sessions in the past week and volatility sliding back toward the high teens. That rally has been driven by strong risk appetite, fears of missing out, and a sense that Middle East war risk has faded, even as geopolitical headlines remain anything but settled. The core engine of this move is the AI and semiconductor complex, reinforced by robust bank earnings. Semiconductor stocks have jumped around 20% this month, helped by raised guidance from key equipment makers and ongoing capacity expansion by major foundries. Big technology names continue to announce multi-year investment plans in custom AI chips and data center infrastructure, with some estimates pointing to around $1 trillion of AI-related capital spending over the next few years. On top of that, Wall Street banks, such as Bank of America and Morgan Stanley, are reporting record equity trading revenues, and capital markets activity in mergers and initial public offerings remains resilient despite geopolitical noise. Beneath the surface, however, leadership is narrow. Recent gains are concentrated in a small cluster of mega-cap technology and AI beneficiaries, while broader market breadth is weak and only a handful of sectors finish many days in positive territory. Energy shares have given back their gains from March, even though oil prices remain above pre-shock levels, reflecting limited profit upside for producers when regional facilities are disrupted. At the same time, luxury stocks are under pressure as disrupted tourism and softer demand in the United States and China weigh on earnings, with some high-profile names seeing both sales misses and sharply lower valuation multiples over the past year. Valuation and positioning add another layer. The S&P 500 is up more than 10% since late March, and positioning has flipped from oversold to overbought, helped by short covering and systematic buying, which raises questions about how durable this leg of the rally is. At the same time, volatility has dropped from around 31 to roughly 18, and one-month equity put options that are 5% out of the money now trade about a quarter cheaper than before the recent Middle East shock, even though physical oil markets remain under severe stress and the next day or two of ceasefire and blockade negotiations are critical. Many allocators are watching whether upcoming earnings from mega-cap technology, together with any broadening into financials and small caps, can offset potential margin pressure from higher energy costs as we shift focus to the rates backdrop. Turning to rates, the dominant theme is a higher for longer policy stance, but without a clear move back toward aggressive tightening. Market expectations for Federal Reserve rate cuts this year have been largely pushed into next year, and the Fed is signaling a willingness to keep policy on hold for an extended period. Officials point to balanced labor market conditions, but persistent inflation overshoots, while inflation expectations remain well anchored around 2% on popular five-year measures. Political noise around the central bank has not, so far, altered its operational autonomy, which supports the credibility of this higher for longer narrative. In the euro area, the picture is more conflicted. Ongoing Middle East tensions are already weighing on regional growth and inflation, pushing the economy away from the European Central Bank's previous baseline, and a significant slowdown without outright recession is now seen as the central scenario. Markets have sharply reduced the probability of a rate hike at the April meeting from around 4 and 5 to closer to 1 and 3, yet the ECB continues to stress its readiness to react if inflation surprises on the upside, with internal projections ranging from the mid-2s to above 4% and worries about faster wage responses after recent price shocks. From a portfolio angle, yields near multi-decade highs mean diversified, high-quality fixed income can provide meaningful income, even if duration calls are less clear. Some observers expect the traditional 60-40 equity bond mix to regain diversification benefits as rate volatility stabilizes and near-term Fed easing is priced out. There is also a view that inflation-protected treasuries currently offer the lowest risk way to preserve long-term spending power, particularly if successive energy and tariff shocks keep headline inflation bumpy, and hold real rates at elevated levels. The key tests for this rates narrative are the next inflation prints and the trajectory of energy costs, which will also feed directly into credit conditions. In credit, public markets still look remarkably calm. Corporate bond spreads remain tight by historical standards, supported by solid fundamentals and limited net new issuance, and large banks are reporting strong first-quarter results. At Bank of America, for example, consumer credit quality is improving, with lower delinquencies and charge-offs, high average credit scores, and conservative mortgage loan-to-value ratios, while stable, low-cost deposit base is supporting net interest income growth that has just been guided higher to the mid-single digits. Private credit sits at the center of the more nuanced story. On the one hand, Wall Street banks collectively report over $100 billion of exposure to private credit firms, but in most cases that represents only 1 to 2% of total loans and is often structured to be relatively low risk. Institutional demand remains robust, as shown by large purchases of private credit fund bond offerings by major asset managers and renewed deal flow with global investment banks. And many expect secular growth in this asset class to continue for years, drawing in new types of investors. On the other hand, rapid expansion, concentrated sector exposures, and looser underwriting during the easy money years are now revealing weak spots, especially in semi-liquid vehicles that offer frequent redemptions against inherently illiquid assets. Current stress in those structures is driven more by liquidity mismatches than by broad impairment of underlying loans, but can still amplify volatility and contagion when redemptions spike, and wealth clients and such funds may encounter unexpected constraints. For allocators, the combination of tight spreads, strong bank earnings, and these localized liquidity pressures means monitoring bank disclosures, private credit default trends, and any shift in deal terms as key indicators of where we are in the credit cycle. In foreign exchange, the story is less about dramatic safe haven moves and more about slow structural shifts. Several countries are working to route a larger share of trade and payments through non-dollar channels, in part to reduce vulnerability to sanctions, which modestly challenges dollar dominance over the long term. At the same time, there is still an enormous pool of more than $22 trillion sitting in low-yielding cash and money market instruments, leaving considerable capacity for cross-border flows if risk appetite or relative yields change. Wealthy clients are increasingly diversifying not only across asset classes, but also across currencies and booking centers, aiming to spread geopolitical and jurisdictional risk. That trend is reinforced by the current conflict, where disruptions in key shipping lanes raise particular concerns for major energy importers in Asia that rely heavily on oil transit through strategic straits. For multi-asset portfolios, FX exposures are therefore becoming an important way to express views on geopolitical resilience and policy regimes, and not just a byproduct of local equity or bond investments, which brings us back to the commodity channel that is driving many of these shifts. Commodities, and oil in particular, remain the macro pivot where geopolitics feeds directly into inflation. Shipping activity through the Strait of Hormuz has collapsed from roughly 100 to 120 vessels a day to just 1 or 2 attempts, as a United States-led naval blockade turns merchant ships away. Physical crude markets are extremely tight, with prompt cargoes trading up to $30 above widely used financial benchmarks, signaling a panicked bid for immediate barrels, while inventory levels are drawn down and supply increasingly comes from strategic reserves whose capacity for further releases is limited. There are glimmers of potential escalation. The United States and Iran are preparing for a second round of peace talks ahead of a ceasefire deadline, and direct negotiations between Israel and Lebanon could, over time, reduce some of Iran's leverage via regional proxies. Yet the talks face serious hurdles, including disagreement over how long Iran would suspend nuclear enrichment, and the next 24 to 48 hours are seen as critical in gauging Iran's response to the blockade, with risks ranging from limited asymmetric strikes to broader attacks on Gulf states or United States bases as additional troops and warships move into the region. The consequences extend well beyond crude. Persistent supply blockages are disrupting fertilizer flows and raising the risk of food scarcity in vulnerable countries, while rising electricity costs in parts of Asia, driven by tight energy markets and AI data center demand, are becoming major political and economic issues. Layered on top of earlier tariff shocks, This creates a stagflationary backdrop that could delay any meaningful fall in inflation and push real interest rates higher, with imported energy inflation emerging as a key threat to both corporate margins and deal activity. This is one reason some observers argue that traditional 60/40 portfolios may need explicit commodity and real asset exposure in a world where long-dated government bonds may no longer hedge growth shocks as effectively. Pulling it all together, we have equity indices near records, led by AI beneficiaries and strong bank earnings, even as breadth is narrow and near-term hedging looks inexpensive. Rates markets are converging on a higher for longer glide path, with the Fed on hold and the European Central Bank balancing weaker growth against still lively inflation risks. Credit remains tight and well-behaved on the surface, though private markets expose structural liquidity vulnerabilities, while FX is slowly reflecting the dollarization efforts and wealth diversification across currencies and jurisdictions. Commodities, especially oil, continue to flash stress, with the Strait of Hormuz and strategic reserves at the center of the stagflation debate. The key signposts for allocators now are the progress of Gulf ceasefire talks, the evolution of shipping flows and energy prices, upcoming inflation data, and the next round of mega-cap tech and bank earnings. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.